First up, the Sim Value Fund has an enviable track record of outperforming the all-share index, having posted annual returns of 21.4% over the 10 years to September, compared with the all-shares return of 17.6% over the same period. This has made it the number one performing fund in the value sector and one of the best performing funds in the market overall. The fund is run jointly by Rico Friedrich and Claude van Kyk. Here to tell us the secret of their success, Rico Friedrich. Hi, Rico.
Good afternoon.
We've boosted your ego now with that introduction, so now we'll get some of the details.
Most definitely, yeah.
Let's start just with your general view of the market. We read your most recent newsletter and you identified 3 or 4 major themes, I think creating a great deal of uncertainty for investors, one of them being global monetary easing, and we don't know where this is going to end and what it means for investors. If we start there, what's your interpretation? So how are you acting based on that?
I think what's particularly interesting, if you have a look, we're sort of 5 years now since the start of the global financial crisis, and things haven't panned out, much different to the way they had in Japan 2 decades ago. You're still finding growth is fairly anemic around the world. There's not much to really say about inflation at fairly depressed levels, and the monetary policy measures that have been taken so far haven't really been passed through in terms of real economic growth. And that's really where our concern rests. We've continued to see quite substantial measures over the last quarter from a monetary perspective, trying to kickstart economic growth. And I think with the exception maybe of the United States of America, very little indication that those measures are in fact flowing through to the real economy.
Rico, so staying with that point, we know QE and QE2 lifted the markets, and the rational response is believing that QE3 will do the same. But with that, as you say, there's no growth. So doing the right thing means presumably not being so heavily in the market, but going on past experience, it might be wise to be in the market.
Most definitely. I mean, the markets obviously have responded quite well. In particular, if you look at the European markets, we've seen some fairly substantial bounces from some of the economies that have been struggling the most, such as Italy and Spain. And commodity prices too have also responded as they have previously with QE1 and QE2. But every single time you've seen a failure in terms of a follow through from the real economy, with the result that the markets have pulled back in disappointment of an expected improvement from a global growth perspective. I think what is particularly encouraging is that in the US you are starting to see some fairly healthy signs. If you looked at the job creation numbers that came out last week, and in particular again the housing start numbers that we saw last night, those signs are very encouraging. And I think even more so added to that, the numbers that were reported by China overnight, particularly around industrial production and retail sales growth. So I think these signs are all fairly encouraging and probably will add fuel to the equity markets and the rally that we've seen taking place so far.
Rico, just to take this up, I mean, we've been talking about this mess in the macro economy for some time. Obviously, Europe started things, we had the global financial crisis. And yet we look at the returns that the likes of your fund has been generating over the last year and others, and we actually see it hasn't been that bad. Is there a bit of a disconnect between the returns we've been enjoying in the equity market and the bad news that's coming from the macroeconomic side that we've seen over the last 18 months?
Yeah, that's an interesting point, because I would probably say that's been the case maybe for the better part of the last 18 months. The equity returns obviously are a summation of investors' expectations for the future. So, from that point of view, there's no doubt that the expectations are for a recovery in global economic growth going forward. Having said that, though, equity returns typically don't necessarily display a high degree of correlation to global economic and GDP growth. Really as a result of the timing differences. The market tends to react before you see the actual numbers coming through in terms of overall improvement in the economic fundamentals. And that's pretty much been the case with respect to very much a stop-start from a global growth perspective. One has, in answering that question, one has to also look at valuations. And in fairness, going back to the beginning of the year, certainly from an SA domestic equity investors' point of view, valuations were not excessive. And so the run-up that we've seen now, while in aggregate may translate into equity markets being fairly valued, there's still, from our perspective, areas that are offering reasonable upside from a discount to fair value point of view. But then there are definitely sectors where that disconnect that you refer to is far more accentuated. For example, in the industrial space, where we think, in aggregate, the stocks are very expensive.
Now that's we're obviously very familiar with the retail sector of the market and some of the steamy valuations there. Just in terms of what's going on in the industrial market, some analysts have alluded to the manufacturing base of the country being hollowed out. What is the prospects for the industrial sector at this point, and why are the valuations, in your mind, stretched?
Again, one has to also look at the makeup of the industrial sector. I think it's very different today than maybe what it was a decade ago. You've got some fairly big, large, or dual-listed multinational companies that make up an overall big proportion of our industrial index. And from that perspective, these are companies that have had very strong tailwinds over the last several years. The likes of the Richemonts, the likes of the SABs continue to perform very well in an environment where companies are struggling to grow. And particularly if you look at South African industrial companies, outside of maybe your consumer and services related sectors, those companies are struggling in the face of rising costs and the inability to pass on those price increases to clients or to their customers, ultimately impacting negatively on margins. So again, I think one's got to look at, in slightly more granular detail, that there are some differences, and maybe it's dangerous just to refer to the industrial stocks as a base. But certainly, from the engagements we've had with local management teams, it's tough on the ground. And I think the environment that we're in now is being made worse as well by labor-related issues, and companies having to deal with declining productivity from a labor perspective. All of these challenges, when added together, make for a fairly difficult environment for the South African manufacturing sector, in particular, which is still a big base of the overall SA economy.
Before we talk about some of the sectors that have been offering value for the fund and where you've been investing, I just wanted to touch on the rand quickly, because it's very important to many manufacturing businesses how competitive they are with regards to the rest of the world in terms of exporting their goods and services around the world. Where are we in terms of fair value for the rand against the dollar? Have we reached fair value at the moment, or do you still see some more weakness in the rand?
Again, I think it's been our view for some time that the fair value for the rand based on a purchasing power of parity basis is around the mid 8 rand levels, which is not far off from where we are currently. So, we don't see any sort of fundamental reason for a significant further deterioration in the rand against particularly maybe the US dollar. But obviously there are other events that certainly from a short-term perspective may have a significant bearing on monthly or quarterly fluctuations in the exchange rate. But from our point of view, we're not uncomfortable with the levels where the rand is at now.
Rico, looking at some of the stocks that you say might well offer some value in the industrial sector, and you've made it quite clear that there's little value to be had in that sector, but we mustn't be misled by averages, so go for the granular. As you say, you're a bottom-up fund manager. And just looking at that list, MTN and Steinhoff probably very little in common, but the fact is that just having spoken about the rand, those are potentially rand hedges. So is that not then a reason for you choosing them as offering value?
It's certainly not the primary motivation for investing in either of those two companies. If I were to take maybe Steinhoff as an example, what we first typically like to look for is companies in industries that can maybe grow faster than the average company in the industry, and generate returns for shareholders that over time creates value for shareholders maybe faster than the average company would. And Steinhoff, we think, is a great example of that. It's a business that has been through a significant metamorphosis over the last 24 months or so, and has translated or presents management with a significant number of opportunities to extract value for shareholders. So in particular, they now have substantial critical mass in terms of furniture retailing in the European environment, which on the face of it may not seem to be an attractive space to be in, given the pressures that consumers in Europe are facing. But they continue to grow market share. They continue to benefit from scale in terms of their ability to leverage off their purchasing power out of China, to leverage off their distribution network that's growing. And these factors, in spite of what's happening from an overall economic perspective, we think will translate into good value creation for shareholders over the next 3 to 5 years. A weakening of the currency is just really a cherry on top, but it certainly doesn't form an important part of our investment thesis.
Rico, just one of the interesting things in your portfolio, and I think something we've spoken about previously, is you've kind of favoured a position in Anglo-American with what you call the stub, which is the unlisted businesses of Kumba and Amplats taken out. For a value investor, the resource sector is an obvious place to start. So just fill us in with your thinking around Anglo in particular and some of the other companies that you think are offering value in the resources sector.
Well, maybe a good place to start is just to look at resources compared to some of the other opportunities. There's no doubt when you look at financials, industrials and resources that the resources sector is the area that looks the most interesting to value investors. However, one needs to be fairly cautious with that approach as well, because while currently there's an expectation for a growth in earnings out of the resources sector in the forthcoming 12-month period, when you look at where spot commodity prices are now, it would indicate that there's significant downside risk from an earnings perspective. Now, that doesn't form the major part of our focus. We tend to take a much longer term time horizon, and we tend to look at commodity prices that we think are sustainable on a through the cycle basis. And Anglo-American stands out for us because apart from its investments that it has in platinum and obviously iron ore through Kumba, there's a significant portion of unlisted assets which are largely made up of base metals. There is a little bit of iron ore there too, which we think is significantly underappreciated by the marketplace. In fact, we're fairly negative on iron ore overall as a commodity. We think that the prices are too high. They have come off substantially over the last year, but even at the levels that they're at now, we think that there's still potentially further downside risk. And therefore, when investing in Anglo-American, we prefer to take a stake rather in those underappreciated base metal portion of their portfolio, which is in essence trading on maybe a 5 or a 6 times price to earnings multiple, versus the likes of an Amplats, which depending on the earnings that they're going to show over the next couple of months, is on a much higher PE multiple. And similarly, Kumba iron ore, when you normalize the iron ore prices to more sustainable levels, also doesn't look cheap. And so we prefer to gain exposure to those core assets, which in our view offer almost 100% upside to intrinsic value. And that's far more attractive than any other opportunities we're seeing in the commodity space now. And that's why it's our top holding in our portfolios.
Rico, we're going to have to end the conversation there. I can hear this could be a long one, and we haven't spoken about some of your other industrial holdings that you reckon offer value. That includes some of the construction stocks like Wilson Bailey Homes, Sun International and Lewis. But we might do that on another occasion. Thanks, Rico. Friedrich, Fund Manager at Sanlam Investment Management.